Hello and welcome to the key metric of operating expenses. In the past two videos, we've talked about income. Now we have to talk about expense. Where you're going to start is with the seller's property level financial information. They're going to give you exactly what their costs were for the past several years. Hopefully more than two. Hopefully you get 3 or 4 years of property financials, but 2 is the minimum that you'll see. Now, that's a good place to start, but there are opportunities for you to reduce costs, but there's also the potential that costs could go up because the seller was doing the maintenance, or the seller had a cleaning business and he was giving himself a sweetheart deal. There's a lot of room for change within operating expenses. So you need to be really careful using what it was and figuring out what it will be when you buy it. And the biggest one is real estate taxes. Now, real estate taxes are very stable until there is a property sale, because a property sale triggers the tax assessor to reevaluate the property based off of the new sale price. So if real estate taxes were $100,000, they could go up to $120,000 the next year after you buy the property, because the tax assessor comes out and reestablishes a new value for that property. So you really want to make sure you understand the property taxes in your municipality and get a really good estimate of what that's going to be. The next is insurance. It's very straightforward. You call any insurance broker, they'll give you a quote, they'll tell you what you need, and that's going to be important. If you're getting into direct ownership, you need to have insurance. Next is repairs and maintenance. Now this one's interesting because there's a lot of fluctuation. And if a seller knows he's going to sell a property in a few years, I've seen in the past where a seller will reduce their maintenance costs, meaning they're not really maintaining the property to the appropriate standard, in order to decrease operating expenses and increase the potential sale price. So you want to look at the trend and you want to really understand what the repairs and maintenance have been and make sure that the seller has been properly maintaining their property. Next is a management fee. Property managers earn a fee. And if you're managing the property yourself, you could pay yourself a fee. Or that's a great way to reduce costs and increase your NOI for your personal reasons, your personal goals. So management fees, depending on property type and size, can range anywhere from 4 to 12 to 16%. It's usually single digits, but it can be pretty high. So if you're going to outsource management, get a really good quote and hopefully lock in that rate because it can be very expensive. Next is G&A. This is your accounting software, your lawyer, maybe a secretary. Maybe you have a maintenance guy and you're paying him payroll. He would go under here. So that's just a general bucket for general fees or costs associated with managing this property. Cleaning and landscaping can potentially be a really big expense line item depending on the size of your property, which is why I broke it out. You'll always see an other bucket. They're going to throw, extra random stuff in another bucket, but you want to understand what's in there because that may be really important. And maybe really important costs that you hadn't otherwise thought of. And then last but not least are utilities. Now, depending on the property type and the lease agreement, sometimes utilities are completely reimbursed by the tenants, sometimes they are not. So you need to know what you're getting into. Is this a cost that you're going to bear or a cost that the tenants will ultimately bear? Now, every property and asset type are different. So these expenses will vary between asset classes, and there will be asset class specific costs. But a general rule of thumb is you want your operating expenses to be roughly somewhere around 40%. Now, asset class specific, that varies, right? Some asset classes have much lower margins, but that's a good ballpark if you're a small balance direct investor. If your NOI is 60% or 50%, you're probably in a pretty good place. If your operating expenses are 60% or 20% of effective gross income, there's probably an error in there somewhere. So it's just a good rule of thumb. It doesn't mean that's what it should be. It's just a ballpark figure for you. to get started. So that is operating expenses. In the next video, we're going to talk about NOI, which kind of brings these all together.